Another ugly open on the cards here from New York City this morning. Good morning, good morning. Your equity market is lower, much lower. On the S&P, down by more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, gearing up for a big week ahead.
This week is jam-packed.
Fed meeting,
Chair Powell,
Q4 earnings reports,
and of course on geopolitics.
So many kind of conflicting events taking place.
Fed is going to have to move.
We have 7% inflation.
They've got to hike interest rates.
So many people have been hooked in this era, hooked to this drug of cheap money.
The pendulum swung too far, if you will.
Also think about softer earnings.
It's going to be the employment cost that really people are going to be watching.
There are bigger picture issues here.
What everyone's going to be looking at.
It's very difficult for all of us to determine what's next.
With futures lower, much lower, joining us now to discuss is BlackRock's Tony DeSpirito, Jay Jacobs of Global X, and JoAnne Feeney of Advisors Capital Management. JoAnne, let's just start right here. What are you looking for out of this week?
Well, there's certainly a lot on the table this week, and I think the market behavior and all of these risks that they're facing really is testing the mettle of the long-term investor. Obviously, with the Fed, coming out this week with new information, a lot of expectation that they're going to be signaling a bit more aggression to get inflation under control. Do also, though, expect them to cite the continuing economic recovery. Yes, clearly, growth is slowing down. But growth isn't going away, and we have to remember what got us here. And what got us here was really strong consumer demand coming out of the pandemic, driving up inflation amidst short supply. And we're seeing both of those things change a bit. Supply is coming back, probably slowly. Raising interest rates probably crimps demand a little bit. And so there's some reason to believe that the time right now is to focus on the growth potential at the fundamental level in earnings and sales. And those still look pretty solid.
28 minutes out, this equity market is down and down hard. We're down by about 1.5, 1.6% on the S&P. On the NASDAQ, we're down by almost 2 full percentage points. Tony, as you see things right now, what is the biggest risk at the moment? Is it inflation, the story of last year, of much of the last 12 months, or is it the policy response to it?
Well, I do think the underlying economy is strong. You have to look at the consumer, both in terms of the income statement. Job growth is up, wages are up. Also, the balance sheet. Right now, things look very different for the consumer than they did coming out of the global financial crisis, and that's really important. And then when you think about corporate spending on capital investment and whatnot, that's also going to be strong, right? Wages are up, and so what do you do when wages are up? You spend on capital to save money on labor, to reduce your labor costs. And so I think the economy is going to continue to be strong. The question mark is rates, and rates need to come up. The Fed is behind the curve. We have 3.9% unemployment. Wages are growing 4.7%, and yet interest rates are still short-term interest rates are pegged at zero, and the Fed is still buying bonds in QE as we speak. So that needs to come to an end. That will cap the upside to the market, but that doesn't mean it's going to be a weak year.
And Jay, I think that point that Tony raises is so important. QE isn't over. It's still going. It still continues. The Fed hasn't fired a bullet yet. This is just talk. Talk about 4 hikes, talk about QT, just talk, the risk of them doing more, just talk. And still, Jay, this market's correcting and correcting hard. What's your reaction to that?
Well, I think it's possible that the market could be selling off too quickly at this point. There's still a lot of unknown risks out there. There's still geopolitical risks now in Eastern Europe, but also if there's any confrontations or economic challenges outside of Asia with the Omicron variant continuing to cause some localized shutdowns. So it is possible that we don't see as aggressive actions as the Fed throughout the year if these risks continue to materialize. And if that's the case, that could be a bullish indicator for the markets again. It's moved so quickly just in terms of Fed expectations. Piece after piece, research after research that drops into my inbox. It reads the same thing. Whether it's Citi, Goldman or Deutsche Bank, it's all about the risk of doing more. This from Deutsche Bank. Our baseline expectation is March liftoff, 4 hikes in total this year, QT to begin in early Q3. We also see meaningful risk the Fed will have to undertake a more aggressive policy tightening this year to combat inflation pressures. Mike McKee, you're going to be covering the story this Wednesday. Have you been surprised how quickly economists have factored in much tighter monetary policy?
Well, they've sort of been following inflation higher, and they're hitting an air pocket where they don't know exactly what's going to happen with the Fed. Take a look at the weekly calendar ahead. It is very busy, a lot of economic data coming out, but I'd point you to just two things. Obviously, the Fed meeting on Wednesday, but look at Friday. The employment cost index and the PCE inflation numbers. Remember, Jay Powell said it was the ECI that turned the Fed hawkish when it came out back in December. So we'll see what the latest numbers are and how much that affects people's views of what the Fed is going to do. You can see here how the numbers have been, the ECI wages have been following inflation higher on the PCI side. If that keeps up, the Fed's got a real problem, and maybe some of those hawkish predictions come true. The other aspect of it is, what does the Fed say about the balance sheet, and what do they say about guidance going forward? Interest rates, obviously, they're going to set up for a March hike, but the balance sheet they'll probably talk about discussing, but no deciding yet. That'll be something we'll watch for in the minutes. And then guidance, this whole question of 25 or 50, they'll probably punt on that and say we want to see more data. And the same thing with 3 or 4 rate moves. But then Friday comes and we get more data.
We get more data, and we need more data. Mike McKee, thank you. I mentioned Citi, Deutsche Bank and Goldman all raising the bar. Goldman's Jan Hatzius doing the same thing over the weekend. He wrote the following: we see a risk that the FOMC will want to take some tightening action at every meeting until that picture changes. This raises the possibility, I stress possibility, of a hike or an earlier balance sheet announcement in May, and of more than 4 hikes this year. JoAnne Feeney, I want to come to you on this. Historically, and I stress recent history, the more we price in, the less the Fed actually delivers because of tighter financial conditions. Is it different this time for you, JoAnne?
Well, we haven't seen this kind of inflation and wage pressures in a long time. So that does change the calculus a little bit. You know, as an economist, I can tell you that it's going to take a long time for us to see the results of any Fed rate increases in the inflation numbers. And so while the Fed is data-driven, I think they are going to have to be fairly aggressive here. But let's think about where this leaves us a year from now, which, you know, really ought to be in the calculus of a long-term investor. You know, clients are worried clearly about the sell-off, and they talk to us about it. And, you know, we're seeing a lot of situations here where the anticipation of the rate hikes, right, obviously causing a pullback in the markets and multiples declining, does give a lot of opportunity for the long-term investor. And so, you know, that's something to think about now, because we've seen a lot of these valuations come down pretty sharply. Yes, we're going to see some pretty strong rate hikes, we think, over the next year. And the Fed is probably going to have to stay fairly aggressive about that because of the lag in moving rates and having it show up in lower inflation numbers. But we are lapping the period of time when prices really started to go up, and that should show up in the May, June, July numbers. And that might, you know, make the market realize that potentially with the Fed moving, that the inflation problem is going to dissipate over time. And imagine where we are 6 months from now if that starts to happen. All of a sudden, folks are going to be wanting to get back into these more risk-oriented investments. They're going to see how much opportunity has developed now, particularly in the technology stocks. And so we could be in a very different situation in 6 months. And I just think investors have to be careful right now not to panic and lose the opportunity that the market might be presenting us right here, right now.
The calendar might be on their side. I'm with you. The base effects could drift the other way. I'm not totally convinced the Federal Reserve has given up on the essence of transitory, even if it's given up on the word, and we can hear more about that this coming Wednesday. But this market's corrected and correcting fast. The S&P's down another 1.7% this morning. The Nasdaq is now down more than 2%. Katie Lyons, last week, the worst week since March 2020, and it was a 4-day trading week.
A 4-day trading week in which every single day the NASDAQ 100 went lower, John, ending the week 7.5% down. That, as you say, was the worst week going back to March of 2020. And we've seen this kind of pattern emerging where you try to see a rebound overnight or even early on in the U.S. trading day, and then we roll over. And that is exactly what happened in the futures session today, with NASDAQ 100 futures now down more than 2% after being positive earlier on before the European Open. Now, of course, going back, it's not just the broad benchmark that is in correction territory either. Obviously, it's been painful for the NASDAQ 100 as a whole, but maybe no surprise when you look beneath the surface of the S&P 500, you see some of those individual sectors in correction territory as well. Technology, for example, is down about 13% up from its 52-week high, and communication services, which houses Alphabet, Meta, Netflix, they're down about 16%, obviously dragged lower by the steep declines for Netflix after its disappointing earnings last week. And of course, John, we have more tech earnings on deck. Mega caps Microsoft, Tesla, and Apple will be reporting throughout the course of this week. week, plus that Fed decision on Wednesday, all of which could be potential further catalysts for a badly beaten technology sector, John.
Kelly, thank you. Tony, I wanted to talk about the pace of this move, the fact that we had a 7.5% move lower on the NASDAQ 100 in just 4 trading days, the fact we're down another 2% this morning, the fact that Netflix was down almost 22% in a single session. Tony, what do you gauge from that?
Well, if you look at the long-run history of stocks, 10% or more corrections are quite common. You should expect a 10% correction once every 13 months. We haven't had that since March of 2020, so almost 2 years now. And so I don't think this is something to get panicked about. I think this is something that happens on a regular basis. We just haven't seen it in a while. And on the points of transitory inflation, there's still aspects of inflation that are clearly transitory. I mean, take a look at used car prices, up 37% in the last report. That's not normal. That's simply because there's a chip shortage and we're producing too few new cars. Once that alleviates, you're going to see used car pricing actually maybe flip negative and actually contribute to a reduction of inflation. So I do think there are some positives, and it is important to stay constructive on markets here.
Jay Jacobs, final words there.
There's been a lot of investors who have been waiting exactly for a pullback. And so I think, a more aggressive stance here is what is being sold off that shouldn't necessarily be selling off right now. There's areas of tech that are actually quite profitable that should not be as sensitive to these anticipated interest rate moves in the robotic space, in the clean tech space, in the semiconductor space, that still have pretty high growth expectations and just should not be as interest rate sensitive as we're seeing. So there are opportunities here to be aggressive and be buying rather than selling.
We'll talk more about that into the opening bell. Jay Jacobs, JoAnne Feeney, Tony DeSpirito sticking with us. Let's get you some single names as well and touch base with Abby. Morning, Abby.
Good morning, John. And the one name to take a look at once again, Netflix, as though that nearly 22% decline you were just mentioning on Friday weren't enough. After a 25% decline from the November peak, we have these shares down about 4% once again. So nearly down 50% from the peak, pointing to an inflection point. And Evercore ISI seems to be supporting that idea, saying that Netflix may no longer be a long-term core play, that the Netflix revenue growth just does not support the premium valuation. Some of this, of course, is all of the competition. This used to be a monopoly-like business, not so much anymore. Plus, the race for content, John, as this company has to amortize it sitting on the balance sheet. Lots of factors for investors to weighing on that stock once again.
Abby, thank you. Coming up on this program, the U.S. sending a warning to Russia.
We are preparing massive consequences for Russia if it invades Ukraine again. We've been concerned and have been warning about exactly these kind of tactics for weeks.
That conversation up next.
Obviously, we don't believe what Russians and Putin is saying. He's been in Ukraine and was fighting with us for the last 7 years. We're not going all the way in the history, but this 7 years already costed us more than 13,000 people dead and 7% of territory. So why would we believe him right now? Ukraine poses the threat, existential threat for Russia, not of our actions, but because we are existing independently and the way we are trying to build our society.
The White House ordering families of diplomats to leave Ukraine due to the threat of Russian military action. EU foreign ministers also recognizing the threat and condemning Russia.
This isn't a time to increase military activity and tension in the context of what's happening with and in Ukraine at the moment.
We're convinced that the real war is a likely possibility.
Putin should know that the price to use provocations and use military forces to change border in Europe will be very, very high. They will be totally isolated and they will have harsh reaction from all of us.
The Russian President Vladimir Putin has repeatedly denied he currently plans to attack Ukraine. Joining us now from Washington is Bloomberg's Anne-Marie Hordern and from Brussels, Bloomberg's Maria Tadeo. Morning, Maria.
Yes, Jonathan, and there is a meeting that is now underway between European foreign ministers and, of course, also the U.S. Secretary of State, Anthony Blinken. The idea here is how to coordinate sanctions. And this is really a moment of decision, particularly for the European Union and in particular Germany. You know very well that for years, Germany has been criticized for being ambiguous, for having this ambiguity when it comes to its commercial but also diplomatic relations with Russia. And at one point, Berlin is going to have to decide whether or not they want to send military equipment, whether or not they want to sanction big and go big against the Kremlin and Vladimir Putin. The flip side to this, of course, is that they still say that they believe there's a diplomatic way forward, but Putin will have to pull back those troops. The issue, as you know, is that over the past 48 hours, what we've seen is Russia deploying even more forces to the Ukrainian border.
Anne-Marie, a ton of reporting over the weekend, stateside in Washington, D.C. on all of this. What's the latest?
So overnight, what we learned is that the U.S., following up on our scoop last week, that they are telling members of diplomats at our embassy, the United States Embassy in Kyiv, that they should return home and that there's a voluntary option for those that work in that embassy. And then, Jonathan, shortly after that news came out from the State Department. What we learned from the Biden administration in a New York Times report is that they are weighing potentially sending troops to Eastern Europe on that eastern flank. This would be right on President Putin's doorstep. We're talking about aircraft, warplanes, on top of that as well, 1,000 to 5,000 troops. This would be a major shift for the Biden administration. Now, while the president had alluded to this, if they're actually thinking about this, this would certainly be a shift and really would start to change potentially the analysis that we are seeing from President Putin and the Kremlin as they amass 100,000 troops on the Ukraine border, Jonathan. On top of that, planned war games in Belarus and off as well with the naval military off of the border of Ireland.
Anne-Marie, thank you. Anne-Marie Hordern alongside Maria Tadeo. Team coverage, transatlantic. Back with us, Tony DeSpirito, Jay Jacobs and JoAnne Feeney. JoAnne, as you know, a lot of people look at situations like this. They recognise how serious they are. They have no idea what it should mean, will mean for financial markets. How do you interpret a situation like this one?
Well, Jonathan, yeah, obviously a lot of uncertainty. I think the biggest consequence for financial markets, if such an event does transpire, will be the sanctions, because that's not just going to hurt Russia, but it will potentially, constrain European growth. And so when you're thinking about maybe allocating assets, you might want to be a little bit wary of Europe. We think Asia and emerging markets are still good places to be. One way to have defensive positions in the portfolios is to own some of the defense companies, because not only would this signal, higher pressures on the military over just the short term, but also potentially the long term, if this is building up into a more significant Cold War or hot war. And so owning companies like, LMT or Kratos or Raytheon, I think are good ways to put a bit of insurance into portfolios. But, that's clearly part of the elevated risk that we're seeing in the markets, causing folks to get out of some of these risky assets. Obviously, we're going to have a lot more information about this over the next 6 months, which brings me back to my earlier point. Think about the underlying fundamentals as a long-term investor. We still have very strong consumer demand and household balance sheets here in this country. And we're likely, by the way, to see a shift over to services consumption now that COVID is once again fading. And that, by the way, also takes some pressure off of inflation. So clearly a lot to worry about. But again, longer term, we're seeing some really good opportunities here across the board, and some ways to put some insurance into portfolios for defense, in banks, for example, to protect against higher interest rates, and insurance companies, et cetera.
John, as you mentioned first, Europe underperforming this morning, and that's clear for me, and my apologies for jumping in. When you look at the equity market stateside, down 1.8% on the NASDAQ, look to France, look to Germany. In Germany, the DAX is down by more than 3%. Jay, would this situation shape where you would have that exposure, geographically speaking?
Well, I think the natural reflex of these markets is going to be going further and further into energy. When you have Russia involved and it's supplying a significant amount of fuel to Europe that it could shut off or limit at any time, that could be a significant disruption in the energy markets, which have already seen oil prices rise. We continue to see valuations in the space be much lower than they were, even 5-6 years ago. And so I think as we see this shift to cyclicals and we see more inflation, and now we see this heightened geopolitical risk, I think this is going to be probably one of the most bought sectors over the next several weeks as people prepare for this situation.
Tony DeSpirito, final word here, sir. Final word.
Yeah, as you know, John, I've been a big proponent of having a balanced, a barbell approach to the portfolio, both risk-taking in cyclicals as well as in safety and stability stocks. Certainly on the risk-taking side, energy has been front and center for almost 2 years, for a year and a half now. And I couldn't agree more that this is, the developments in Russia, as unfortunate they are, they're positive for energy markets. On the flip side, in that stability bucket, I would certainly include defense stocks, and they've been an overlooked area over the last 2 years. But the world's getting more dangerous, not less dangerous, and so I do think they definitely belong in that barbell.
The performance of energy equities has been absolutely stunning. Energy this morning on Brent down 1.6% to 86.45. On WTI down about 2% to 83.47. Staying with us, Tony DeSpirito, Jay Jacobs and JoAnne Feeney. Coming up on this programme, the morning calls. And later, Microsoft, Tesla, Apple, all reporting earnings this week, going into a really, really tricky period for tech stocks. The Nasdaq last week down 7.5%, the worst week since March 2020. The S&P 500 did not sit the sellout out. It was down by 5.68%, the worst week going all the way back to March 2020. The longest, shortest week that I can remember in a long, long time. From New York City this morning, good morning. The opening bell, 7 minutes away. The biggest one-week loss going back to March 2020, and we take some more weight off the S&P, the Russell and the Nasdaq. The Nasdaq 100 down by 1.9%, the S&P 500 down by 1.6%. Last week, you will have noticed nominal yields on a 10-year didn't do much. Real yields did the heavy lifting there. That's where the pain came from in the equity market. Phenomenals right now, we come back in. We're down 5 basis points, 4 or 5 on 10s to 171. On 2 years, we broke 1%. We're back down to about 98. Going into the Federal Reserve with expectations right up here, do we fall short of them? Does the Federal Reserve lean the other way? And should you, Neil Dutter of Renmac, saying maybe that's the short-term trade here. We'll build on that through the morning as well. That's the price action. Let's get you some morning calls. We kick things off first of all with Wedbush downgrading Snap to neutral. The analysts seeing headwinds stemming from rising competition and Apple's new privacy policy. That stock is down 6%. Piper Sandler upgrading Discover Financial to overweight, seeing significant warnings, upside potential due to the Wall Street's conservative estimates. We're down by 0.75%. And finally, Jefferies downgrading Netflix to hold. The analyst highlighting numerous question marks following last week's big earnings miss. We're down another 3% this morning. Coming up, following the biggest one-week loss since the depths of the pandemic, Morgan Stanley says winter is here. Your opening bell is up next. This is Bloomberg. 25 seconds away from the opening bell in New York City this morning. Good morning. A messy morning so far. Let's work through the price action. Down 1.5% on the S&P. The Nasdaq down aggressively last week in just 4 trading days, 7.5% lower, just like that. Again this morning, down about 240, negative 1.67%. The good news, off session lows. There's the opening bell. Switch up the board and get to the bond market. Here's the story this morning. A bid, a curve that is flatter, not steeper. Yields aren't higher, they're lower. On a nominal yield anyway, we're down 5 basis points to 171. Crude to lower 2, negative 2 percentage points to 83.45. And the dollar is stronger. Euro dollar 112.96, a break of 113, down 0.4%. Here's the open then. About 20 seconds in, we are negative 1.36% on the S&P 500. Every single industry group is in negative territory on my screen right now. The financials down by 1%. Information technology down by almost 2%, off by 1.8%. Consumer discretionary, bottom of the pile here, down by a little more than 2%. That group is down 2.16% on my screen at the moment. Should you buy the dip? It's going to be a conversation you hear a lot on programs like this one through today. Nadia Lovell of UBS says maybe you should.
The market is near oversold territory. So we are looking forward for this narrative to change and some stability in the market going forward. I think that investors have become somewhat spoiled in the last couple of years of not seeing any sort of pullback to this magnitude. Usually you see a couple of these 5% pullbacks. So we're starting to see that market approach that oversold territory and really opportunity to start thinking about buying those dips.
So here's the pullback. Let's talk about it. Tony DeSpirito, Jay Jacobs, JoAnne Feeney. JoAnne, the difference between a market correction you want to buy and one you want to run away from. I ask that question a lot. How do you draw this distinction between the two?
Go back to fundamentals, Jonathan. You know, you've got to look here and see how much these things have sold off relative to their potential in the future. And what we're seeing is intrinsic value for a lot of the companies that we like, higher quality tech companies in particular, is higher now than where these stocks are trading. And the way you look at that is to look at end demand. What are their market opportunities? You know, a company like a Microsoft or a Broadcom or a Qualcomm, right? These have all pulled back, and in some cases, 20% or more. And the opportunity for them has to come back to fundamentals. These are companies in a growing market. Cloud computing is growing. Consumer wealth is still growing. The demand is out there. You want to take the opportunity to get involved in these names if you're not already. And so we think that that's a good signal for investors right now. Again, have to look to the long term in this kind of a situation because the risks are not going to go away anytime soon. But the market is telling us something. The VIX right now is really elevated, but the curve is inverted, right? Everyone recognizes that we're having a lot of uncertainty now, and we should get a lot of clarity as the year goes by. And so position yourself for not 6 months from now, but for a year or 2 years from now. And that tells us find these quality technology companies and own them here.
Tony, same question to you.
So I look at balance sheets. I look at the balance sheet of the consumer. I look at the balance sheet of corporate America, and they're both in really great shape. And that's what distinguishes the period we're in now versus post-global financial crisis. So I do think fundamentals are going to continue to be strong. We're in this period of heightened uncertainty because the Fed is pivoting, right? Pivoting from quantitative easing and zero rates to something more aggressive on the monetary side. But I think we're in an economy that can handle it. The other thing I'd point out that we haven't talked about today is COVID. And that's a really good thing because the numbers are falling. And I think that's a real positive that the market's overlooking at the moment as that transitions from a pandemic to an endemic. And then finally, I'd highlight a couple of all-weather sectors, like healthcare, for example, where that's a sector that continues to grow. It's based on demographics. We have an aging demographic. There's more and more need for healthcare, and yet the valuations are very reasonable. And so I think that's an example of a great all-weather cycle that you can be sector that you can be investing in, regardless of the short-term outlook.
Jay Jacobs.
I completely agree with JoAnne's point around quality tech. When you see such aggressive selling in such a short period, you have to be looking for what's being thrown out with the rest of the market that doesn't necessarily justify that. One example I'll highlight is robotics companies. These are, first of all, profitable companies. This is not, pie in the sky technology. This is technology that exists, that is being monetized today, that should benefit from the rising labor costs that we see in the market and the disrupted supply chains. And yet it's selling off even harder than the broader technology space right now. It simply doesn't make sense when you see some of the magnitudes of these sell-offs versus the long-term opportunities ahead of them. So I think if we look at the fundamentals, if we look at the balance sheets, and we look at the structural growth opportunities in tech, I think there's buying opportunities, and they're not even that hard to find right now.
It's selling off hard right now. The Nasdaq off by almost 2%. The S&P 500 down by 1.5%. Apple earnings coming up later this week on Thursday. With your earnings story, here's Abby.
John, well, after the Netflix disaster last week, lots of nervousness and anxiety around these big tech earnings this week. Starting tonight, IBM. Tomorrow, we'll have Microsoft. On Wednesday, Tesla and Intel. And then on Thursday, the really big one, Apple. Now, what's really at play here, slowing growth. In the third quarter of last year, growth on a year-over-year basis for tech overall up 42%. For the fourth quarter, it's expected to slow to just about 14%. That's a key quarter, so that's a real big slowdown. Plus, looking ahead into 2022, low single digits. But after that huge jump in growth, it shouldn't be too surprising that we're seeing this sort of a slowdown. But it's definitely unnerving investors, especially as cheap liquidity money particularly possibly comes out of the system. Not surprisingly, really weighing on the NASDAQ 100. About 18% of members are above the 50-day moving average. 39% members are above the 200-day moving average. Not good readings. Not surprisingly, that NASDAQ 100 now about 6% below its 200-day moving average. The question is, will it be like 2020 when the slide just keeps going, or more like 2018 when there was a little back and forth up Right now, deeper technicals suggest that, similar to what many of your guests are talking about, there could be some sort of a bounce ahead. Maybe the Fed, John.
Abby, thank you. The team over at JP Morgan weighing in on this. This is what they've got to say. It's hard for investors to buy tech and growth stocks while the market remains wary over the FOMC meeting, earnings and US PMI data. Worry over earnings also makes it difficult to buy into value stocks that are sensitive to the economy. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Well, it's not been a great year to own U.S. stocks in general, but it definitely has been worse to own growth. When you look at the Russell 1000 Growth Index, which basically tracks all the growth stocks in the U.S. market, it is down about 13% on a year-to-date basis. Its value counterpart only down by about 4%. So that margin of outperformance actually puts value on pace for its best month relative to growth, going all the way back to December 2000, more than 2 decades. And just to take it one step further and look at those beyond those broad baskets of value and growth, look at the sector breakdown. Up top year to date, maybe no surprise, energy up about 11%. It trades at a much, much lower forward PE multiple than the likes of technology or consumer discretionary, which are the two biggest sector laggards, each down between 13 and 14%. It's a lot harder to justify those high premiums in a rising rate environment. But of course, John, when we talk about value, we aren't just talking about U.S. stocks, because when you look across regions, the U.S. is actually still more expensive. That Russell 1000 Value Index trades at 15.7 times 12-month forward earnings estimates. European value stocks, though, at just 10.7 times. So that's why you're seeing value stocks in Europe and as well in Asia actually outperforming value stocks here in the States this year. Investors looking for those discounts in other parts of the world, John.
Kelly Lyons, thank you. Note of the weekend coming into this week came from Mike Wilson of Morgan Stanley. The note started with "Winter has arrived" and finished with "Enjoy your Sunday." OK, thank you, Mike. Here's the quote. "The end of secular stagnation and financial repression has arrived, but it won't be a smooth ride. In the near term, hunker down for a few more months of winter as slowing growth overtakes the Fed as the primary concern. In such a world, we continue to favour value over growth. But here's the important part. With a defensive rather than cyclical bias, hibernate until winter is over." Two parts to this. Tony DeSpirito, I want to lean on you for the first part. This is how it stacks up for a lot of people. Inflation's the problem. The next problem is the policy response to it. The next issue down the road is slowing growth. Are we already at step 3 where the concern right now, Tony, could quickly become slowing growth, when you've talked up repeatedly through this program that there is no concern about growth right now?
Yeah, so I think those are great questions. I think it's way too early to be worried about slowing growth. First of all the underlying fundamentals are very strong. Yes, the Fed's going to be raising rates, but it's going to be careful. It's going to be careful not to overdo it. And so I do agree with Mike's statement that value is likely to be favored in this kind of environment. Valuation spreads are very wide by historical standards. That's a good setup. That, combined with rising rates, historically, value has done best in periods of rising inflation and rising rates. So the setup for value stocks is very nice. I think it's been very nice for about a year and a half, and we're really just starting to see it come through in stock prices. I think it's way too early to be worried about getting too defensive.
So within value, JoAnne Feeney, do you take the same line that Tony says? Lean towards value, but keep that cyclical bias, not the defensive bias that Morgan Stanley and Mike Wilson are thinking about?
Yeah, I think that's a better approach, is to find the quality growth where you can. But we've always leaned toward value at Advisors Capital. And what we look for in the growth names are growth at a reasonable price, not strictly value by any sort of quantitative metrics. But also very important, I think, at this point to recognize where the growth is going to happen. I think it's really important to be selective here. What are the areas of the economy that are continue to grow regardless of what the Fed does? Certainly, we see some of that in tech. But we also see the housing market as a real plus, even with rates rising. There's still so much demand out there and such a shortage for houses that we think that's going to be an ongoing tailwind. And not only do you look at the home builders, but you can look at the suppliers, you can look at the furniture makers, the appliance makers as places to go. And so we think it's really important to be selective in where you find that value. And certainly after this pretty significant sell-off, there's certainly a lot of it in tech, but also in consumer discretionary, where there's been some concerns about that longer-term growth. Agreeing with Tony here, it's a little bit hard to call the long-term growth picture. Clearly, the market is building in a short-term slowdown, which is appropriate, and now is a good time to go shopping and find some of those value names, but be very selective about it.
Jay, you can tie yourself in knots trying to work all this out. There's so much to worry about. I don't know what to be worried about. Is it higher inflation, the response to it? Slower growth further down the road? What is it, Jay?
It's all of the above, and it's also the fear of the unknown. I mean, these are markets that we just haven't been accustomed to. With rising inflation, this has been a long time since we've last seen it. Just a persistent sell-off. It's been 2 years since we've seen the markets really sell this quickly without people immediately rushing to buy in the dip. So I think the fear here is, from a market's perspective, are people responding the right way, or are people getting panicked too early? I think we remain optimistic that because there's a lot of cash on the sidelines and because there's really relentless demand in the economy, that things should rebound fairly quickly. But this is somewhat unprecedented and fresh to the market. So we remain concerned about how people are going to react and just what the technical selling looks like.
Jay, can I finish there with you? Can you be worried about all of the above, and particularly the first two? Can you be worried about both higher inflation and the response to it, higher interest rates? Last week was a great example of that. Break-evens rolled over, real yields rose. Last year we were betting on inflation. It seems to me that it's changed. We're betting against it because we're betting for higher interest rates, higher real rates, to be more specific. So, Jay, I'm trying to work out, can I be worried? When I'm approaching these markets, is it intellectually consistent to be worried about higher inflation and the response to it?
Absolutely, because these things take time to trickle through the markets. We're seeing the high inflation now. It's going to take a year for the Fed to probably get up to 1% in the federal funds rate. This is going to take time until that really starts to slow down demand and you see inflation curve. So it's absolutely consistent. I think what investors have to be thinking of is, what is their investment time horizon? Is this short-term trading or is this long-term investing? That's going to change whether you're trying to play the current inflation or if you're trying to play kind of the longer-term trend here, or at least medium-term trend of now being in a rising interest rate environment.
Jay Jacobs, JoAnne Feeney, Tony DeSpirito, to all three of you, thanks for being with us. About 13 minutes into this session, your equity market is lower, the bond market is bid, the curve is flatter into your equity market. About 13 minutes in, we're down 1.5% on the S&P and negative 1.9% on the NASDAQ. Tony DeSpirito mentioned it. We've hardly talked about coronavirus, and let's hope that's going to be a theme for the year still to come. Coming up, New York City coronavirus cases starting to recede.
We are not sure exactly what's next, what the virus will do. So many people got Omicron that there's a hope that whatever comes next will be better prepared for it.
More on that next. This is Bloomberg.
Things are looking good. We don't want to get overconfident, but they look like they're going in the right direction right now.
Dr. Fauci says things are looking good. Dr. Sharfstein of Johns Hopkins sees challenges adapting to the new normal.
Challenge we have, I think, is finding that new normal where people really feel comfortable, because you run the risk that you say, okay, we're going to be fine doing A, B, and C. And half the people think that's too restrictive, and half the people think that's not restrictive enough, and nobody's happy.
Things getting better. Let's bring in Sam Fazeli of Bloomberg Intelligence for more. Hey, Sam.
Hey, John.
Are things getting better, sir?
Well, I mean, the peaks of some of these infections are coming in slowly, at least in some of the states in the U.S. and certainly in the UK, we've seen that. So for this particular wave, not only we're seeing this rise and then fall, and then how long that will last, we'll have to wait and see. But we certainly are seeing, as I put out in a note today, in at least a couple of countries, which we're looking at, UK and Denmark in that note today, you're seeing much, much lower levels of ICU admissions, hospital admissions. So from those perspectives, it's looking fine.
Yesterday's story, I hope, Sam, I hope, and I hope over time we talk about different things and less about this. Sam Fazeli there of Bloomberg Intelligence. The S&P is where the focus is right now because the risk has changed. The risk is no longer just about Omicron. It's not about inflation per se. It's about the Fed's response to it. The Fed's response to it sending the S&P 500 down 10% from the peak we saw in the last couple of weeks to start the year, January 3rd, to be precise. And now we're talking about the potential of a Federal Reserve doing something into weakness. Mike McKee looking at the data stateside. Hey, Mike.
Yeah, that's the problem, John. The Fed, if they start to tighten, has to figure out how far it can go before it breaks something. And the latest data suggests, as you were just talking about in that segment on Omicron, that people were not comfortable in January. The market ISM numbers come in a dismal drop in all three of them. The manufacturing PMI down by about 3 points for the month of January. Services PMI off by 7 points. And the suggestion there is that maybe people did not want to go out of the house because of Omicron. So we've got to find a new normal, and that pushes the composite down by 6 points. So the U.S. ends up in a much worse place than it was. And as you can see, the European numbers there, Germany did okay, but for the U.K. and for France and for the Eurozone, all lower numbers. And so it does look like we had a rough month of January, and the central banks have to figure out what happens next.
Mike, people are going to find it very, very tempting to say we can look through the near-term weakness associated with Omicron and look forward to better growth in the year ahead. Do you think the Federal Reserve will take the same view?
They have had the same view, and they probably will retain the same view that inflation will come down and the economy will pick up. But so much is driven by the virus, people just don't know.
Tricky, isn't it, Mike? I just wonder what they lean into in this news conference Wednesday, and you and I are going to be talking about it through the week. You'll lead the coverage on that. All these notes talking up 4 hikes baseline, $1.5 trillion balance sheet reduction from midsummer through year-end 2023, and the idea that maybe they can do more, Mike. Have you ever seen things move this fast, as fast as they have done over the last few weeks?
Not really. I mean, you saw when the Fed had to react to the coronavirus back in March of 2020, but we've really moved quickly, and we have the same problem for the markets as we had then. Nobody knows what's below. They're jumping into the void. So people making a lot of bearish predictions that may or may not come true.
Mike McKee, thank you. About 21 minutes into this one, to paraphrase Mike Tyson, everyone's got a plan to buy the dip until they get punched around the face by one. Right now, we've got one. The S&P 500 in correction territory, down by 2% on the day, down 10% or so from the recent record highs. The Nasdaq down by 2.33%, down aggressively last week by 7.5% on the Nasdaq 100. And then we're down another 2% and some on the Nasdaq with the sector price action. Here's Critty.
Well, good morning, John. You really just hit it there. Tech is going to be leading the sell-off today, but essentially all 11 sectors are in the red. At the bottom of the pack, you have both financials and consumer discretionary. This is interesting because remember that correlation between tech and yields is now positive. So when you have yields drop, tech is down with it. Financials as well, taking its cue from the bond market. To the top, though, you do have consumer staples, the least negative out of all 11 sectors, with a little pocket of green in their household products like Colgate, for example, Colgate-Palmolive, I should say, or Clorox. Those are your stocks in the green. You're very few stocks in the green, I should say. Something that you're not going to find in the S&P 500, though, is going to be those crypto-exposed stocks. Your names like Riot Blockchain, Marathon Digital, down a whopping 12% intraday. This has everything to do with the kind of decline in Bitcoin in particular that you have been seeing for the last couple of months. The question, John, just like in the stock market, is when do you buy the dip, to your point?
Critty Gupta, it's a difficult one to answer. It always is. Do you think this is just that, a dip, a correction, a short-term move lower, or something that risks translating, materializing into something a whole lot worse? Your bond market's bid, that's for sure. Yields in on a nominal 10-year yield by 4 or 5 basis points to 171. On twos, backing away from 1%, down about 2 basis points to 98 basis points. On the day, this curve is flatter. Coming up, your trading diary, a ton to get through as we build up momentum into the Federal Reserve decision this Wednesday. This month is not over yet. I'm sure some of you are hoping it is. 3 full weeks and a trading morning. We're down another 2% on the S&P. We're down by almost 10% on the year on the S&P 500. On the Nasdaq, we take more weight off the Nasdaq 100, down another 2.3%. That's the equity story. Here's the bond market bid. Switch up the board and get to 2s, 10s and 30s. Yields are lower right now by 4 basis points on 10s to 171.56 on 2s. Backing away from that line in the sand. That 1% we breached very briefly. We're down 2 basis points to 98. That curve is flatter, but expectations have kept on building on the south side. Who can out-hawk the next bank? Citi, Deutsche Bank, Goldman Sachs, all talking up the risk of doing more than 4 hikes this year, doing more than just balance sheet reduction, kicking off in the summer. I can't keep up, can you? Your 30-year yield down 2 basis points, just north of 2%. That's the price action. Let's get you the trading diary. Some Treasury issuance coming up a little bit later this morning, later this afternoon to be precise. Selling $54 billion in 2-year notes at 1 p.m. Eastern Time. Then the earnings start. IBM reporting results after the closing bell. Plus, President Biden discussing efforts to lower prices for working American families at 5 p.m. Eastern Time. He wants to put the attention on the domestic story. Right now, the attention is on the international one and the tension between Russia and Ukraine. Then we get a Fed rate decision and Chairman Powell news conference on Wednesday. US GDP and Apple earnings coming up on Thursday. And finally, on Friday, the employment cost index in America. Deep breath from New York. This was the countdown to the open. This is Bloomberg.